America, welcome back to another round of Sound Retirement Radio. So glad to have you tuning into this episode. This is episode number 377. The title is Roth Conversion. A good idea? Before we get started, I like to get the morning started right two ways. The first one is by renewing our mind. And this verse comes to us from Luke 1, verse 77. To give his people the knowledge of salvation through the forgiveness of their sins. As you get older, it is possible to become wise as a result of life experiences. I've learned that when I go golfing, to always bring an extra pair of socks, just in case I get a hole-in-one. If you've been keeping up with retirement planning strategies, you probably have heard about something called a Roth IRA conversion. But what is it? And should you do one? A Roth IRA conversion allows you to turn your traditional IRA into a Roth IRA. And this can be a great option for people that want to pay fewer taxes in retirement. In today's show, we're going to discuss why and how to do a Roth IRA conversion. I have to tell you, I'm so excited. One of the reasons I'm doing this episode is because we just launched a new feature inside the Retirement Budget Calculator. For those who subscribe to the premium service of the Retirement Budget Calculator, we've released the most recent update. The new Roth Conversion function allows you to simulate Roth conversions so that you can see how converting a traditional IRA to a Roth would affect your retirement plan. Roth conversions may come as a surprise to you because they're not the best strategy for everyone. So what is a Roth conversion? A Roth conversion is the process of turning your traditional IRA into a Roth IRA. When you convert, you'll have to pay income taxes on the amount that is converted. However, this may be worth it for some people because qualified Roth IRA withdrawals are not taxed in retirement. In other words, you will have already paid taxes on the money that is in the Roth, so you won't have to pay any taxes when you withdraw it in retirement. The distinction between Roth conversions and Roth contributions is important to keep in mind. Contributing to a Roth IRA has income limits. You can't contribute to a Roth IRA if your annual income is too high. However, the income restrictions do not apply when it comes to Roth conversions. Why are people considering converting some of their IRA to a Roth? The main reason that people are considering Roth conversions is because of the current low tax rates. On December 31st, 2025, many of the provisions of the Tax Cuts and Jobs Act will expire, and the current tax rates are scheduled to go up in 2026, and the standard deduction will decrease at the same time. So if you think you'll be in a higher tax bracket in retirement, or if you like the idea of paying taxes while tax rates are low, it may make sense to do Roth conversions now. Another good reason to do a Roth conversion is because of the way our national debt is growing. The U.S. national debt is currently more than $30 trillion, and it's only going to continue to grow. This means that tax rates could be going up in the future. I found a couple of fun quotes about taxes. This one's from Ronald Reagan. He says, "The only people who pay taxes are the ones who work for a living." Albert Einstein says, "The hardest thing in the world to understand is the income tax." Benjamin Franklin says, "In this world, nothing can be said to be certain except death and taxes." Oliver Wendell Holmes says, "Taxes are what we pay for a civilized society." Will Rogers says, "The only difference between death and taxes is that death doesn't get worse every time Congress meets." People who complain about taxes can be divided into two classes: men and women. So before you do a Roth conversion, it's important to create a comprehensive retirement cash flow plan before considering doing any Roth conversions. Some people will end up paying more money in taxes during their lifetime if they do Roth conversions. And doing Roth conversions might cause you to run out of money earlier than you had you not done the conversions. We don't want to let the tail wag the dog. In other words, we don't want to let tax planning be the primary driver in your decision matrix. Roth conversions should be thought of as an added potential benefit to a good retirement cash flow plan. The next thing you should do is project how much tax you'll pay without Roth conversions throughout your lifetime, and then determine how much tax you'd pay throughout your lifetime if you did Roth conversions. The difficult aspect of this exercise is that we don't know what the tax rates will be in the future. Because of the unpredictability surrounding future tax rates, The most frequent technique for predicting taxes is to assume that current tax law remains constant over time. In some cases, we'll discover that Roth conversions might result in more taxation through a married couple's lifetime, but they may be worth it when you consider the tax-free distributions to your heirs and the fact that you won't leave your kids a huge tax obligation when you pass away. When you do Roth conversions, you generally pay taxes. Doing Roth conversions does not eliminate paying taxes. It just allows you to decide when you're going to pay taxes. A common question people have is, do you have to convert all of your IRA at once? And the answer is no. You don't have to convert all of your IRA at once. It's more common to do a Roth conversion in stages. You can convert just enough to max out your current tax bracket, and this can help you minimize the amount of taxes you pay on the conversion. You can also spread the conversions out over several years, and this might be useful if your income drops because of a job loss or the retirement of your spouse, causing you to fall into a lower tax bracket. Because the Roth was not created until 1997, the bulk of individuals born between 1950 and 1970's retirement savings are tax deferred in 401ks and IRAs. Many people in this demographic didn't even have access to the Roth 401k until more recently, which means that the majority of their money, their retirement accounts, are tax deferred. And you can diversify your future tax obligations by converting IRA assets into Roth IRA accounts. So you say, okay, Jason, this makes sense. How do you determine how much to convert? The best strategy for everyone is going to be different. There's no one-size-fits-all answer. You need to consider your circumstances when deciding whether or not to do Roth conversions. Some of the factors you should take into account include your current tax bracket, whether you expect your tax bracket to be higher or lower in retirement, the size of your traditional IRA, how long you expect to live in retirement, your other sources of retirement income, how much you pay in tax with no conversions, whether or not you want to leave a tax legacy for your heirs. Will it impact how much of your Social Security is taxable? Will Roth conversions impact other areas of your life, such as how much you pay for Medicare Part B and Part D premiums, or the premiums you pay for health insurance under the Affordable Care Act? Once you've considered all of these factors, then you can begin to create a plan to help you decide the optimal strategy for you. Which brings us to the next question, which is, when is the optimal time to do Roth conversions? And again, I wish there were simple answers to this, but the reality is there is no single right answer to this question as to the optimal time to do Roth conversions. It's really going to vary depending on your circumstances. However, there are a few things you should take into account when making your decision. Your current tax bracket is one of the most important factors to consider when deciding whether or not to do Roth conversions. If you expect your tax bracket to be lower in retirement, Roth conversions may not be a good option for you. However, if you expect your tax bracket to be higher in retirement, Roth conversions may be the best choice. Many individuals anticipate that their taxes will be lower in retirement. And if you have a large balance in your IRA and 401k accounts, when you start to consider those required minimum distributions on traditional IRA accounts at age 72, many people find themselves in a higher tax bracket than while they were working. The Roth IRA has no required minimum distribution, which is one of the benefits. So if you don't need the cash, you can let it continue just to compound and grow tax-free in that account until you do need it, or until you leave the money to the next generation. Another neat feature of Roth IRAs is that qualified Roth distributions do not count against the Social Security taxation. Provisional income is a term that's used to describe the amount of income that is subject to taxation for Social Security benefits. And there are several types of income that are included in provisional income. However, qualified Roth distributions do not count against provisional income. This means that you can take Roth IRA distributions without affecting your Social Security benefits. Qualified Roth distributions also don't count against the income-related Medicare adjustments that can cause people to pay higher premiums for Medicare in retirement. And so this is another advantage of converting traditional IRAs to Roth IRAs for retirement planning purposes. There are 2 5-year rules related to the Roth IRA. The first is for Roth IRA contributions, which stipulates that the Roth account must be open for at least 5 years before you may withdraw the growth tax-free, and that you will generally be subject to a 10% penalty if you use the funds before age 59 and a half. Each conversion, on the other hand, has its own 5-year clock. You must retain the converted amount for 5 years to avoid the 10% penalty for early access on the principal before age 59 and a half. The 10% penalty for withdrawing principal before age 59 and a half no longer applies after age 59 and a half. If you're older than age 59 and a half, you do not need to be concerned about the second 5-year Roth conversion rule, because being older than age 59 and a half makes you exempt from the 10% penalty for early withdrawal of principal. To